So guys, welcome to week 7 of our portfolio update. And as I've been saying for the last few weeks, I feel like a bit of a broken record, but it is a very volatile record, and that is because of this man here, Trump. We are now approaching the implementation day of Trump's tariffs, which is the 2nd of April. And this has caused a lot of volatility in the market, although we've actually seen a little bit of a recovery today. Now, I don't actually think that this has anything to do with the market itself. I think it's more to do on the fact that on the on the first day of the month, you tend to see a little bit of a rise in everything, just because I believe it's because everyone gets paid. It's like a global payday, or just a day which a lot of retail investors invest that little bit of money. In terms of a bit of a longer horizon view than just today, it does seem like people are starting to turn a bit more pessimistic. What will actually happen? Everyone's still unsure, and people will be unsure until we see some more news on these tariffs, what actually happens, what relief Trump will actually give to different countries. But Goldman Sachs did cause a bit of shock in the market, with Goldman Sachs raising its probability of a US recession happening in the next 12 months to 35% this week, up from a prior 20% probability. So obviously, experts get it wide of the mark all the time. And in regards to my investment portfolio, it won't affect anything. We've got our plan set out. We're going to be dollar cost averaging. Whether it goes up, whether it goes down, we're just going to continue with the plan. Obviously, they are well regarded by a lot of people. They've got the technology. So a lot of people think, what are they seeing which I can't see? And Goldman Sachs did see that they can lose the stock market, losing 5% over the next 3 months. Now, obviously, we have already entered correction territory within the S&P 500. Correction territory is basically when you reach when a major indices declines by 10%. Now, they're obviously thinking that the tariffs could slow economic growth, um, which is a similar view to what I have, really. I do think that we will see a further decline in the stock market this year, if not especially volatility, which is why I'm not going to try and time the market. So talking about the S&P 500, how has that affected our first pie within our investments? So if I put it up here, we are down 0.79%. Now, this is actually quite good because I know loads of people out there are down 10, 12% because they brought it basically at its all-time high, thinking it was going to continue to go. Whereas, as I said in my previous video, basically it drops by 10%. There's a going off of like what's happened historically. When a correction occurs, there's a 75% chance of it recovering, or there's a 25% normally chance of it dropping further. Um, I've sort of been of the opinion that I think it is going to drop further, but obviously you want to cover your basis in whatever scenario. So if it does recover, I just wanted to make sure that I wasn't sat out the stock market waiting for a crash that would never happen. So what we have seen is that, yeah, we're down 0.79%, which is quite good because we went down to about -2% last week. Not that it matters to me as a long-term investor. I sort of want it to drop a bit further so I can get a better entry point. Unlike the last time the S&P 500 actually dropped, though, we have seen a bit of a decrease in our rest of the world pie. So um, last time the S&P 500 had the correction, basically what we saw were people trying to reallocate and scurry away from America to basically get exposure to the rest of the world. This time, now it's sort of dropped a little bit. It seems like it's just affected the global market. Now, obviously, we're just sticking £5 a day in this pie, and we haven't started it too long ago, about 17 days ago. But as you can see, China has bounced back a little bit from when people were moving their money over there from America. Europe's had a little bit of a decline. India's we're a little bit green on, not much, but they've had their own turmoil in their stock market even before America. FTSE 100 is a little bit down, and we've got the FTSE Japan down. Now, if you see this screenshot here, you're probably thinking, oh, well, the Asian ones there are further down than, say, the European ones we've got. Now, actually, we had article from Reuters basically saying the People's Republic of China, Japan, and Korea have reached an agreement to collectively respond to Trump's tariffs. So obviously, people must be thinking that, there's going to be more isolation than there already is between the left-hand side of the world and the right-hand side of the world, which people obviously haven't taken kindly to, which has been reflected in those indices there. So in our long-term pie, we are up overall, and this is basically basically, for the reasons that I've already explained in this video. The FTSE All World we are slightly down on. Obviously, this is a combination of companies all around the world. It's quite weighted to America, which means that it's quite reflective of how the S&P 500 moves at the moment. Whether this changes over time, we'll yet to see. But we are slightly down on that. We could be down more. But Berkshire Hathaway is our saviour as always. They've been very cash heavy for a while, and I think the fact they're so cash heavy as a company at the moment has made them a bit of a safe haven for investors to move their money into during these uncertain times. Also, as well as what they do, they basically, as I've said in my previous updates, they basically are very good at creating value by basically getting income companies, taking the income, and then investing it in undervalued companies. The fact they're sitting on so much cash obviously means that they don't think there's that much value in the market at the moment. Obviously, that's just one company, and you have to follow what everyone's doing, but it is definitely an interesting insight because I think the fact they went into cash sort of shows that they were ready for this correction. What we were negative on last week, though, is Realty income, and we're actually in the positive. I think this is mostly to do with the fact that it's hit its ex-dividend date, so people are trying to basically just get that dividend. Obviously, what you tend to see is that just before an ex-dividend date, a stock tends to rise, and then after its ex-dividend date, it tends to drop by roughly the same value as the dividend paid. We really care about the price of Realty income. What we're trying to do is basically build as many shares as we can so we can get that reliable stream of income from the dividends being paid every month, which we can basically where we can get to a point where we can drip feed that into the rest of our portfolio. What we have done is actually created a new pie where we've invested roughly £85 so far. And we've got iShares Physical Gold. Basically, gold does really well in times of uncertainty. If I had my choice, would I basically invest in it now when it's all-time highs, where it's already shot up over the last 3 months? Probably not. But in my mindset with this, and also you'll see below that, we've got global aggregate gilts. With these, I thought that when you're as young as I am, it's a struggle to invest in something that's not growth. But I do want exposure to these assets in the long term. So I just thought I'll put a small allocation to them in the pie. Obviously, when I get older and stuff, I can invest in them more. But it just means that I can build up them without, without the temptation of going into assets which have basically historically returned higher returns. So although they haven't returned as much, they are very good to have in your portfolio in cases of times like this. Now we've also got iShares listed private equity. So private equity has more risk to the rest of our investments, but also it's got the ability for greater returns. I mean, I might sell this in the future, but being 25, obviously time is on my side. It's the same with the Global Growth Fund. So this has got a ticker of JGGI, and historically this has beaten the S&P 500, and it pays a decent dividend. Now again, when the market is in turmoil like it is now, these are more likely to decline a lot more than the other indices we're invested in. But because purely on the fact that I am only 25 and these are long-term investments, and it doesn't matter where they go in the next 5 years, as long as we're hoping in the next 25, 30, we get a good return on investment. I just thought that it was better just to, expose myself to that little bit different side of the market. Obviously, we sold a lot of my stocks in November. So that means our total stock portfolio is only at £3,790.57. That is with £600 in cash, which equates for the £20 each day for April. And why is it so low and doesn't equate to a title? Well, that's because in our cash ISA, that's where most of our money is at the moment. Obviously, there's going to drip feed throughout the month. So I'm just going to move money as and when. But we've got a total value of £13,062.52 with pending interest of £55.44. Last month, we earned about £54 from our cash ISA, and we're earning £1.57 per day, which is basically a good dividend per day. So I'm happy with that. That's just going to equate to more days in the stock market down the line. Yeah, overall, we are slightly up from the position we were last week. Whether that stays the same, because obviously it's going to be a volatile time, is yet to be seen. But like I said, we're just sticking with what we're sticking. It doesn't matter whether the market crashes. It doesn't matter whether the market recovers. £20 is what we're going to put in.